You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, investors seem to have lost their initial enthusiasm over China's decision to let its currency appreciate against the dollar this week. According to traders, what was first seen as a move to allow U.S. manufacturers and exporters to be more competitive at selling in China became interpreted as more of a long-term shift rather than something that would give the economy a boost right now. Energy, airline, offshore drillers, retail, restaurant, and financial shares all on the move this week. Mortgage rates fell to new lows. The Fed kept interest rates near zero, no news there, but they cast their economic statement with more negative language compared to their previous statement. That was noteworthy. That plus a weak existing home sales report and news that first quarter GDP was revised lower to a growth rate of 2.7% when the street was expecting 3%, all kept stocks trading choppily through the week. And Steve, about the only piece of good news that I could find out this week was that consumer sentiment rose. And consumer sentiment was at its highest since January of 2008. But that in itself isn't going to do it, is it?
Right. This is a little bit of three strikes you're out, I think, in terms of what we saw on the economic front. The change in the Fed's language cannot be understated how important that was when they downgraded their outlook for the economy from it was strengthening to the economy recovery is proceeding. Now that might sound like semantics, but in Fed speak, that is a downgrade in sentiment. And they further went on to say that problems in Europe may be negatively affecting the economy. Now add to that the lowering of the GDP, meaning our recovery was not as strong as we thought it was. So
right.
we're coming from a not so hot base. And then throw in that the jobless numbers are not so hot. So after a 2-week bounce up, we see why there's a reason for retraction this week.
Is it any wonder the market can't find any direction here?
Yeah, that's what I'm looking at, and that the GDP number this morning is just more reason for folks to be skeptical of the current recovery, and I expect that people are going to get a lot more defensive from this point.
And what's on your radar for the week ahead?
That there are a couple economic reports out next week. Always jobs reports is very important, but really, I don't think there's anything strong enough in the news that will help folks until second quarter earnings season starts up in mid-July, and we start to get a preview of the forward-looking guidance. So in other words, people are going to write off what happens in the second quarter because as old news. They want to hear what corporate America has to say about business looking forward.
All right. Well, all of this begs the question, Kevin Matris. What do investors really need to know in order to be successful in today's market?
I think
give us some weekend wisdom.
I think the most important thing to know is really what works and what doesn't. How's that for easy?
All right.
Everybody has heard of the old adage, knowledge is power, right? Well, that couldn't be more true with investing. For example, if you were to take a look at your last big loser, I would suspect that if you analyzed it, you would find one thing, or at least one item, that had you known about it ahead of time, you probably wouldn't have gotten into it in the first place. And I'm not talking about things that are unknowable, like insider information or surprise announcements. I'm talking about stuff that you could have known about or should have known about ahead of time. Like for instance, 50% of a stock's price movement can be directly attributed to the group that it's in. And that oftentimes even a mediocre stock in a top group can actually perform better than a top stock in a poor performing group. So if you were to look at your last big loser and you see that that stock was in a poor group, that was likely part of the problem. Or let's just say that you look at the stock's growth rate. Oftentimes you will see that companies with double-digit growth rates actually do better than companies with triple-digit growth rates. Or you'll see that stocks with crazy high growth rates will oftentimes test as poorly as companies with the lowest growth rates. Mm-hmm. So again, if you take a look at one of your losing stocks, take a look at it and see, did this have a spectacular growth rate? If it had a great growth rate, and if that stock got crushed, ask yourself, would you have gotten into it had you known that those kinds of stocks have spotty track records? Or take a look at the valuations. I've done some testing and I have found that stocks with a price to sales ratio of less than 1 will oftentimes produce returns into double digits. Whereas when you look at a company with a price to sales ratio of greater than 4, oftentimes those stocks will produce a loss. So the point of the story is, if you know about these things, you are in a better position. But if you don't know about this stuff, you can know about it, because all of this stuff is available to everybody. And if you have the right tools, you can easily grab it. So you need to know what works and what doesn't, and that's how you can get an edge.
I was wondering when you were going to get to the point of the story.
I just got to it.
Thanks, I appreciate the time from both of you. Bull and Bear and stock screening still ahead. Stay with us. Here is your Bull and Bear stock of the week. One stock rated a strong buy, the other rated a strong sell. That's what comprises our Bull and Bear of the week. Here to explain and tell us which is which for this week, Shiraz Mian, our resident research director. So the Bull of the week you've chosen is Delta Airlines. DAL, the ticker symbol, right?
That's right. And
what makes it a bull?
the airline sector is a very tough business. It's very economically sensitive. It leads the downturn. It typically leads the upturn as well. Historically, the group has been very indisciplined in adding capacity during the good times, which comes back to bite them in the downtime. With the economy recovering and the overall outlook improving, though there are some doubts on that front as well, this group has been doing exceptionally well. The premium business class, the cargo traffic, the long-haul international traffic, all of those numbers are up. And those things are reflected in the better stock prices for the airline group as a whole. I prefer the majors, and of the majors, I think Delta stands to benefit from this outlook much more than the low-cost carriers and the regionals. They did an excellent job with the Northwest acquisition in 2008. They're on track to capture roughly $2 billion in synergies by the end of next year. They captured about $700 million last year. Remain on track for about $600 million in synergies, roughly evenly between top-line gains and cost containments. And all said and done, remain on track for producing exceptionally high amounts of operating cash flow. My outlook is for about $9.5 billion in operating cash flow through the end of 2012. They have capital expenditure plans for about $3.5 billion, so substantial amounts of free cash flow, which they plan to pay down their debt with. Earnings estimates for the company are going up, margins look good, and we, in our research, have seen in the past that when estimates go up, stock price goes along with it. I'm looking for a 15-20% upside.
All right, not so good a story for School Specialty, though. School Specialty Inc., SCHS, the ticker symbol. That's our bear of the week. Why sell this stock?
This is a small cap, roughly $400 million in market cap. They supply school supplies, furniture, playground equipment, supplemental classroom stuff to roughly 70,000 schools in the U.S. and Canada. And we all talk about this budgetary constraint and fiscal imbalances at the federal level. The picture is even worse at the state and the local level. And these school districts and school boards are funded primarily by the local and state and municipal governments. Budget cuts, the legal mandate for the states and municipalities to balance their budgets every year is forcing them to cut the spending for education. And this small cap name is directly in the eye of that storm. They are seeing lower revenues. The outlook is down. Margins are getting squeezed. costs remain the same. We have seen, in fact, in the last month alone, a 30% cut in their earnings estimate for this year, and even more downside pressure for next year.
Okay, I have to leave it right there for time. We appreciate you coming in for the Bull and Bear of the Week. Don't you go away. We're screening for stocks. At least going to help you with that next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. Now we're going to show you how to screen for earnings yield. I'm not specifically, but our resident stock screener, Kevin Matris, who joins me once again, is going to do just that. It's particularly timely because we're coming up to another earnings season.
Right.
For those who may not know, what exactly is earnings yield?
Well, a stock's earnings yield measures just that. It is the anticipated yield or return an investment in a stock can give you based on the earnings and the price paid for the stock. Now, the calculation for the earnings yield is the inverse of a PE ratio. So check this out. A PE ratio is simply price divided by earnings. A stock trading at a price of $35 with earnings of $3 has a PE ratio of 11.67, which means it's selling at 11.67 times earnings. Another way of looking at this is that you're paying $11.67 for $1 of earnings. If you look at the earnings yield, that is earnings divided by price. Using the same example, a stock with $3 of earnings, trading at a price of $35, has an earnings yield of 8.57%. The earnings yield, also known as the EP ratio, is expressed as a percentage, so a yield of 8.57% would also mean 8.57 cents of earnings for $1 of investment. Now, of course, this is all potential because earnings and prices change, but this is how you create the calculation.
So how does one go about using this?
Well, conventional wisdom has it that if the yield on the stock market, the S&P 500, is lower than the yield on the 10-year T-bill, then stocks would be considered overvalued. On the other hand, if the yield on the S&P is greater than the 10-year T-bill, well, then stocks would be considered undervalued. And the whole idea behind this theory is that bonds and stocks are competing for investment dollars. So there has to be an additional premium or an additional yield giving to a stock investor because of the additional risk that he's assuming in comparison to the virtual risk-free trade that you get on a government-backed security.
And this was even used to forecast the downturn that began in 2007?
Yeah, that's what's pretty interesting because if you were to look at the earnings yield based on or back on June of 2007, the yield on the 10-year T-bill was 4.95%, but the earnings yield on the S&P was 4.19. So stocks were very overvalued based on this metric. Currently, the earnings yield for the S&P is 7.64%, and if you look at the 10-year Treasury, it's 3.26. So stocks right now are the better investment.
All right, give us those parameters.
All right. The screen today is looking for companies with a price of greater than $5. The volume has to be greater than or equals to 100,000 shares on a daily basis. The earnings yield has to be greater than or equals to 8%. And we want the 12-month projected growth rate to be greater than or equals to the S&P 500.
Stocks that came through the screen.
There was about 45 to 50 stocks that came through this week.
Wow.
We've got Frontline, Gulfport Energy, James River Coal, MKSI Instruments, and Novella Systems. All of these companies are good-looking stocks, and they all have very strong earnings yields.
And do you get a mixture of stocks netted out through a screen like this?
Yeah, you're going to see small caps, mid caps, large caps. The key, though, is to be able to look at the stock's earnings yield, compare that stock's earnings yield to others within its group, and then you'll be able to find the right one with the appropriate yield and risk.
And do you own any of these?
No, I don't.
Had to double check,
Had to
didn't
look
you?
at it.
All right. Well, we appreciate the time that you took this week to show us another screen. Don't move. Don't touch that dial because we have another interesting session at the roundtable coming up next. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. More on the market and its lack of direction, unfortunately, with all the regulars back. Steve Reitmeister, our editor-at-large, resident research director Shiraz Mian, And of course, Kevin Matris, that man about the technical side of the markets. So, Steve, I've heard this characterized in a lot of creative ways, this lack of market direction. It's the last one I heard was it's not the selling of stocks, it's just the lack of buying. So I guess that is the simplistic way of looking at it, isn't it?
Yeah, it sure is, but no matter what you call it, it looks like we're locking into a range here a little bit. Unfortunately, that range is not pressing up against the recent highs of Dow 11,300. It looks like maybe the lower end is around that 9,700 that we made two and a half weeks ago. And the high end might be the recent high of 10,500. So that's a bit of room for the market to play in. Right now we're sitting about in the middle of that range.
So Kevin, anything in the technicals that says to you market may break significantly to the downside or the upside here?
Well, it's interesting because I think it was just last week
I asked the same question.
Right.
Yes.
Well, we were talking about the follow-through day, and we talked about all the different things that have to happen to constitute a follow-through day, and it was pretty fascinating. However, though, the follow-through hasn't yet materialized. Mm-hmm. We got above the 200-day moving average. We were up there like 3 or 4 days, and then we fell back below it. What's interesting is that the setup for the follow-through is still in place, but we are in a relatively large range. But if we take out the lows that set this up in the first place, I believe the downside target of 96 and 95 will be put back on the table. But right now, we seem to be range bound.
All right, Shiraz, we are about a week or so away from another earnings season here. Now I'm starting to hear rumblings that earnings estimates may still be a little too high, that the more key information lies in the guidance ahead of the earnings. What do you think of that?
That is true, and we have to keep in mind, just alluding back to the Fed statement when they referred to some moderating influences on the economic growth, and at the end of the day, corporate America S&P 500 would be generating earnings and business in the economy that we have. So if we have some moderation and slowdown in the economy, you would expect that it will have impact on earnings. We need to hear from corporate managements that they can see ahead and they can give us good, clear guidance about the second half of the year and also about 2011. So that will be critical.
And if we see that, if it does materialize, what does that mean for the stock market?
It means that the market would have properly sized up the extent of the slowdown that will be materializing in the U.S. economy, and that's in fact the main struggle that's been going on from the April highs in the market. Everybody appreciates the fact that there are a number of issues that the U.S. economy is grappling with, Europe, Asia, and all these sovereign credit issues, and we need to get clarity as to how much are we slowing down. We are not going into a double dip. We will not probably be growing at a 3.5–4% range, maybe in a 2.5% to 3% range, and that'll be the takeaway from the second quarter earnings season.
Steve, with all this choppiness, all this range-bound trading, is value returning to stocks?
You'd like to think so, that people are taking a look at the fundamentals, but the problem with the fundamentals is what picture are you taking a look at? Are you taking a look at the current estimates that some might think are too rosy, or how much do we have to discount for a potential slowdown in Europe and what that means for, as the waves come across the ocean and hit our shores? If our economy is not as robust as we thought it was, given that the GDP got lowered a second time around, and this is how good we get with the stimulus that was put into place, as that stimulus wanes, the idea of 3% plus GDP, I think, is kind of off the table. And so therefore, right, the estimates are just a shade too high. So I think people are waiting to see it actually happen. So you have the estimates are stable right now, but I think if there is a likelihood, they are most likely to be retracted.
Okay. So Kevin, given all of this, would you be a buyer on dips here?
I would be a buyer on dips. I really still believe at this point that those lows that we saw a couple of weeks ago, I think those lows are still intact, and I think there's a really good chance that they will stay intact. I can make probably the strongest case that we go sideways for a while. That's probably my best bet.
All right, time for each of your stock tip of the week. Steve, what do you got?
I'm going with Target because as a discount retailer, I think because we are going to have kind of a sideways economy and a sideways market, the people are still going to be discount oriented. They've done very well through the early stages of the recession and modest recovery, and also they've recently increased their dividend by 50%, which is no small measure. So I like it going forward as well.
Well, consumer sentiment at its highest since January of '08, as we said earlier. So if that's any indication, the retailers might fare out well here, Shiraz.
I'm looking for a retailer, surprise as well. It's a specialty retailer, PetSmart.
Oh, yeah.
And the basic rationale for the pick is that I'm looking for stable businesses, U.S. North America-centric exposure, and some measure of dividend, as Steve referred to. And PetSmart fully fits that bill. The earnings estimates are going up. The company this week announced a 400 million share buyback program and bumped their dividend by 25%. So I think this will be a good place to be in an otherwise choppy environment.
Okay. Mr. M?
Liquidity Services,
What's
ticker
that?
LQDT. I bet you a lot of people have never heard of it. It's in the internet services industry, and in short, they operate online auctions and marketplaces. I saw somebody liken them to kind of like a bulk eBay. So you have a lot of retail companies that will sell merchandise that they cannot move to one of their sites like liquidation.com, and then you can go there and you can buy stuff in bulk. I mean, if you need 10 plasma TVs, that's where you go.
Oh, okay.
But they have good growth rates. They had big top and bottom line surprises. Very, very exciting company.
Glad you told me that in time for my weekend trip to the flea market this weekend. So choppy through the summer here for the stock market?
That's what it's looking like right now. Yeah, I happen to agree with that. And until there's some great impetus in one direction or the other, and hopefully third quarter earnings, that forward-looking guidance, we get something that we can cling on to that's positive.
You guys agree with that real quick? Choppy through the summer?
I do.
Yes?
Yeah.
Okay. That's all from here. Thank you for being with us this week. We look forward to seeing you next week. Hope the week ahead is a profitable one for you.